Hey guys, welcome back to my channel, Costa Living. We're all about financial education and what they should have taught you in school, but they never did. So we're on the weekend here. It's Sunday evening. Been watching a lot of YouTube videos over the weekend, just kind of catching up on everybody's video, making a lot of comments on other people's videos. My channel is fairly new, and so we're kind of, hoping to get some subscribers there. So, please subscribe to my channel. And then what I'm doing is I'm kind of, trying to add value to, just people out there on YouTube and adding some comments to other people that I follow. And it seems like over the weekend, everybody in the real estate genre is kind of starting to obviously really complain about real estate pricing. And I've made some, several comments about how, yes, the pricing of homes have gone up, but they're actually more affordable now than they've ever been. And it's spurred several debates. And so rather than having a conversation with people, it's starting to become more argumentative, and people don't want to see the numbers for what they are. And so that's why I put this video together today, is it's just, I kind of got, I'm there to share information with you guys. I don't, the facts are the facts, and if you want to accept them, and if you don't, then don't. Now, I understand that people can take information and they can interpret it a little bit differently, and that's why I encourage you to watch, several different videos that are out there. But this video goes over, why housing is actually more affordable than what it's ever been over the last 50 years. We take what, the median house pricing is. We took what the actual interest rates were at any given every 5-year increments going all the way back to 1970. We took what the median income was, and based on a 3% down payment, to try to get you in as little as possible, all the way down the spectrum, and how much of your income would have been used to actually pay your mortgage. And you can see what those percentages are, and we will go over that little video. I'll throw up an Excel spreadsheet, and we'll go through the graphs and the numbers. I started referring people in these other YouTube channels, and we start chatting back and forth to some of the other videos that people were putting this together. So that's why I just decided to do it myself. I'll put a link down below. One of the guys that I like kind of puts the numbers together in a good manner is Jason Hartman. And he actually compares it in a lot of different ways. I believe he calls it the Hartman Index because it's his last name. And he put together a big spreadsheet, and it goes over, oil and gold and S&P and how all of that, if you were to price, the real estate market out in gold, what that's done over the last, 50 years, if you priced out versus oil and everything else, you can kind of see where real estate fits in compared to all the other commodities out there. I'll put a link down below for his channel because I think it's a great channel. And then I just found another individual this week as well, and been watching his channels, but I can't remember his name. I'll drop it down below in the comment. Well, hey guys, I want to thank you. Before we get into the spreadsheet and kind of going over all those numbers, I just got to ask you for that favor. Help Triple D this channel and video. What I mean by that is help smash that like button. Smash the like button. It helps the YouTube algorithm. It just lets people know, hey, this is a great video. This channel's got good content. Check it out. And then again, if you guys can help me develop my channel, by subscribing, hit that little bell notification. You'll get notified of new videos that come out. I don't release a lot of videos. I try to do one a week. Just to get content out there. So you're not going to get spammed by me, but you will get notified just by selecting that bell icon. And then of course, help me just deliver my message, deliver this information by sharing this video with someone who you think might benefit from the information. And if you do that, it doesn't cost you anything. You subscribe, select the the thumbs up notification, and that will be a double D on your triple D. I appreciate it. So let's get into the spreadsheet, and we'll kind of go over the information. Okay, so here's the Excel spreadsheet I put together. I'm was commenting on so many videos about how the price of homes is actually more affordable now than it's ever been, and was just getting into too many debates with people. And so I just wanted to actually put it together myself, put it in a spreadsheet. I've been referring them to kind of other videos that are out there, but this way I can just refer them to my own. This is why affordability of homes is more affordable now than it's been in the last 50 years. So let's just kind of go over the numbers. I tracked this all the way back to 1970. So we have, and I just kind of did every 5 years so this thing doesn't get too long. But we got 70, 75, 80. So it just goes all the way through. And then I broke out 2020 and I did 2021 in July because, the complaint that everybody has right now is home prices are just so expensive. And, Jason Hartman points this out too, as well as, expensive compared to what? But, he has, I think he calls it the Hartman Index, where he compares the price of homes to all kinds of things, and to oil, to gold, to the S&P. And you can kind of see over the years how things have adjusted and how things have become more affordable. But like most people comment, I don't buy my house in gold or in oil. So I did this based on the median income of a household. So this is a 4-person household, which is basically 2 adults. So we kind of go back all the way to 1970 and the median price of the home. So I've talked about this before in my other videos. If you guys don't know the difference between median and average, so the average is basically if you take all the homes and then you just divide them up by how many homes there are. The problem with using an average is you're taking like the super expensive homes. And so I'd like to use the median. And so what the median is half the homes are above this price and half the homes are below this price. So this is the median home price in America, going all the way back to 1970. So the 1970s, you could buy a home for $24,000. And right now, yes, in 2020, it was $270 and they've jumped to $363. So there has been an increase quite substantially over the last year. But let me show you why they're more affordable now. And so you go to the 30-year fixed rate. This is kind of the biggest impact, and this is why my other videos about the housing market and the housing market crash, what's going to correct the market is interest rates. So when interest rates start going up, that's going to adjust the cost of the home. So that is why they're so affordable right now, because as you can see, the rates over the last 30 years have been coming down, and they are the cheapest now than they have ever been. And so what I'm showing you, and why there's kind of a big jump here, as many of you know that kind of watch my channel and other channels like mine, something happened in 1971. And many of you know what happened is we took the American dollar off the gold standard. So when we had it off the gold standard, things kind of went haywire. You end up with inflation, you end up with devaluation of the dollar, you end up with higher inflation. So all these things kind of take effect. And so that's when you see a lot of these graphs and charts for different real estate guys. Guys are talking about the stock market and just money in general and inflation. You'll usually see a big change in 1971. And so there is a jump here. But as you can see, they've been coming down historically. And so what I did is I said, okay, well, we have the median home price. So this is the median home price every year. What can I actually buy with my money? And so if we took the home price, we did 3% down, and then we did the finance amount. And so essentially all we did is we just took the amount that's being financed right here. And so you have the amount that's being financed, which is essentially the price of the home minus the 3% down gives you your finance. And so we kind of did this all the way down. And then what we did is we took what the mortgage payment would be. So what the mortgage payment would be based on what the interest rate was for that year. And so you had the median home price, you had the 3% down, you had the interest rate, finance amount, this was your house payment. So in 1970, you could buy a house for about $159 a month. And so we went through and we did all of these. And then we also took what the median income is. Again, this is the median income for a household of 4. And so in the 1970s, the median income was $8,300. And this month in July, it's about $79,000. So, and then what we did is we took the annual income, which is your median income, and we just figured out, well, what's my monthly pay? So we divided it by 12 and you have your monthly gross pay. So those of you that have watched my other videos and watched my videos on the housing market and just how to become wealthy and rich in real estate, it talks about qualifying for a loan and getting a loan for real estate. And what a conforming loan is, which means you're meeting the guidelines. So what the guidelines are for home is usually between 25 and 35%. I say these are the rules of thumb. 25 to 35% of your gross income can be used for your mortgage. And for those of you that are out there renting, very similar. You have to have 3 times the rent
to qualify for whatever the rent is as far as the rent payment. So the income has to be 3 times the rent payment. It's very similar to what they use for actually qualifying for a loan. And so what we did is we took the monthly gross income, and then we took, of your monthly gross income, what percentage of the mortgage represents your payment from your monthly gross income. So as you can see here, in 1970, your gross income was $694 and your mortgage payment was $159, which meant about 23% of your income was being used for your mortgage payment. And then in 75, we started to go up because we were off the gold standard. It was 28. And then in 80, we kind of hit a high of 43.9. So people were using 43% of their income to pay for a mortgage. And as you can see, as we go through the years here, what has happened after that? It has continually dropped. And so we see a little spike in July because, yes, we do have that overinflated cost right now of homes. But you can see that it's still 21.9% is lower than it's been other than last year. And 2015 was the lowest at 20.2%. So people were using 20.2% of their income in 2015. But for the most part, for the last 50 years, we're at the lowest that it's ever been. So for those of you that, again, keep complaining, well, the prices of homes are too high. It's not the prices of the homes. You can't look at the dollar. Look, if you go over here and look at the dollar, yeah, it's more expensive as far as the price. The pricing is higher now than it has ever been. But look right next door. The rates are as low as they've ever been. And so what that relates to is the rates affect what your payment is. You're actually using less of your income every month to buy your house. And so what I did is I took the payments, the percentage of the payments that have gone towards your monthly mortgage payment, and took, again, the mean of this. This is over all of these years, half of it was above, half of it was below. Actually, the mean, so this is the mean. So the mean is average. So I took the average here. So the mean is the average. The median is half above and half below. So once you got the mean, which is your average, so the mean is your average, the median is a half below and half above. You can see they're actually pretty close. They're 28. So I kind of took the average of the two, which is 28.4. So right now, it's at 21.9%, much lower than what the average has been over the last 50 years. And certainly a lot lower, other than 2015, lower than what it's been for the last 50 years. So what this tells me is we actually have room to grow just to get to the average. So if we use this 28.7, which still throws us in that sweet spot of 25 to 35% of our income. So if we're at 28.4% of your monthly gross income, $6,500, it's going to throw you into a mortgage payment of $1,866. And that $1,866 mortgage payment, based on 3% interest, so the rates are at 2.7 right now, but if they go up a little bit, it's going to throw your median home price to a price of $456,000. We're at $363 right now. So we still got room for about a 30% increase in pricing, which to me kind of lines up with what I've been saying and what I've said in my housing video. Now, this is written in stone, but I pretty much told you that based on what the Fed chair said, they're not raising interest rates till 2023, which is going to be 2 years. And we're seeing about a 15% increase this year in 2021. Probably see close to a 15% increase in 2022. So 15 and 15, there's your 30% increase. That's going to throw you right about in this price point. So for those of you that are waiting to buy a home because you want to see it crash, it's probably not going to crash because we have a long way to go. Now, when we get to the point where you're getting over 35%, so if we're up here in this category here and people are using 35% of their income to pay for their mortgage, one, that's not qualifying loans. So this is where we get into trouble. So this is what happens is the government is going to want more people to afford a home. So if they keep the rates low and the prices of homes go up and people no longer have the income, this is when it becomes an affordability issue. So what does the government do? They start changing the rules. They start loosening up the criteria. So now you're getting to where you can get a loan at 40%, 50%. This is when we're going to have a crash. These are the signs of, there's a reason why we're at 25 to 35%, because that's where it's manageable. That's where people can actually still meet the debt obligations of their other bills. When you're getting to 40, 45%, you're running into trouble. So, when you look at, well, what's $79,000? This is based on what it is. Okay, guys, this is 2 adults working. So you take the $79,000, divide it by 52 weeks a year, and divide it by 80 hours, because you got 2 people working 40 hours a week. That's $19 an hour. So this is the average, or the median, working $19 an hour at full-time jobs. So yes, this isn't minimum wage, but as you can see, it's not a super high-paying job. And so if you have 2 people in your household making $19 an hour, you can go out and you can probably qualify for a $360,000, well, you got to put the 3% down, but $360,000 loan or home, 3% down, you're getting a loan for about $350,000. So you're probably about $350,000. This is guys, where I'm talking to you in my other videos about, hoping to get you guys into rentals. Now, obviously, you have to have good credit, you have to have job history, you have to have those things. So we talk about those on the other videos. I'll put a link in those above on the credit scores, so you guys can understand your credit scores and some things that you can do to increase your credit scores. But this here is what I'm talking about. The homes are more affordable now than they've ever been in the last 50 years. Yes, they've gone up a little bit more in the last year, but they've dropped interest rates again. Fannie Mae just got rid of another 0.5 point that they were charging. So, obviously these rates can't come down much further. There's not a whole lot of space for them to go. I mean, at this point, they're going to be going negative. But again, when I say negative, that's also another thing for you guys to think about. You are buying homes on a 30-year fixed rate for under 3%. Do you guys understand how powerful this is? You are gaining debt. And if you haven't watched my video yet on how to become wealthy through debt and expenses, I'll link that one up above too. But essentially what the government is saying is, you go out and get a home loan, and we will allow you to get a loan at 2.78%. Inflation, which they say is transitory, which is not true. The inflation rate is probably close to 5% right now. So you buy a home, your home is actually going up higher in value than what you're paying on the interest rate, which means they're paying you 2% to go get a loan on a house. Guys, we got to get you in a home. And then also get you into a rental property so you can become financially independent. But I just wanted to put this video out there. I've been getting into debates on other channels, and it's kind of starting to get ridiculous. People just don't see the numbers, or they see the numbers and they go, well, that's just funny math. I don't understand how that works. The numbers are what they are. I'm not creating this stuff. I'm just sharing it with you. So I don't create the information. I just give you the information, and what you guys do with it is up to you. Again, as long as you're in that 25 to 35, the closer you get to 35, you're going to have a little bit more stellar credit. As you're getting down to closer to the 25%, you got some flexibility. And as I told you in other videos, you're pushing 25 to 30% in the front end, and you're pushing about 40 to 50% in the back end for your loans. If you have a comment, drop it down below, and we will answer your questions. I go through all the comments, and I get back to you guys. But I hope you enjoy this. I hope this kind of makes sense to you, kind of going over the numbers, but just understanding affordability of homes and, the interest rates, how they work, and more importantly is how they're cheaper right now. Understanding all this stuff, well, that's a Costa Living. We'll see you next time. Well, guys, I wanted to just jump back in really quick. I didn't want to end it with my little squared face in the corner. But just thank you for, watching my videos. I really appreciate it. And, over this last week, I've had a lot of people subscribe to my channel. I really appreciate it. Appreciate all the positive feedback and comments. And, I read everything down below. So if you guys have a comment, you have any questions about anything I'm posting, just drop a comment down below, and I will get back to you.
and let's just help each other out. We're all here on helping each other become more knowledgeable and become more financially independent, and we'll keep building it. Thanks a lot.